In 2018, the Trump administration made a bold move that sent shockwaves through the global trading system. They decided to impose hefty tariffs on steel and aluminum imports, primarily targeting China. The stated goal was to protect American jobs and industries from what the administration perceived as unfair competition. These tariffs, set at 25% for steel and 10% for aluminum, essentially made it more expensive for other countries to sell these metals to the U.S. The move immediately sparked controversy and retaliation from key U.S. trading partners. The European Union, Canada, and other countries quickly condemned the tariffs as protectionist and harmful to the global economy. They argued that these tariffs would disrupt supply chains, increase costs for businesses and consumers, and could even lead to job losses in their own countries. The Trump administration, however, remained steadfast in its belief that these tariffs were necessary to protect American interests. They argued that other countries had been engaging in unfair trade practices, such as dumping cheap steel and aluminum into the U.S. market, and that these tariffs were a way to level the playing field. This decision marked the beginning of a series of tit-for-tat tariffs between the U.S. and its trading partners, escalating tensions and raising concerns about a potential global trade war. The situation became increasingly complex as countries scrambled to protect their own industries and navigate the shifting landscape of international trade. The European Union, a major trading bloc with close economic ties to the United States, found itself caught in the crossfire of this trade dispute. In response to the U.S. tariffs, the EU imposed retaliatory tariffs on a range of American goods, including iconic products like Harley-Davidson motorcycles, bourbon whiskey, and Levi's jeans. The EU's goal was twofold: to pressure the U.S. to reconsider its tariffs and to compensate for the economic damage inflicted on European businesses. These retaliatory tariffs were carefully calculated to target sectors where the U.S. would feel the pain, hoping to bring them to the negotiating table. However, the UK, then in the midst of its own complex exit from the European Union, opted for a different approach. Despite expressing disappointment with the U.S. tariffs, the UK government decided against imposing retaliatory tariffs of its own. This decision stemmed from a desire to maintain a good relationship with the U.S., a crucial ally, and to avoid further economic uncertainty during the Brexit process. The UK government instead chose to engage in dialogue with the US, hoping to secure exemptions from the tariffs and find a negotiated solution. Canada, one of the largest suppliers of steel and aluminum to the United States and a close neighbor with deep economic ties, found itself particularly vulnerable in this trade war. The Canadian government strongly condemned the U.S. tariffs, arguing that they were unjustified and harmful to the integrated North American economy. In retaliation, Canada imposed its own tariffs on a range of U.S. products including steel, aluminum, and consumer goods. These tariffs were strategically designed to target industries and regions that were politically important to the Trump administration, applying pressure to reverse the tariffs on Canadian metals. The U.S. and Canada were already engaged in tense negotiations over the North American Free Trade Agreement, and these tariffs further strained the relationship. The Canadian government argued that Canada was not a national security threat to the U.S., the justification used by the Trump administration for the tariffs, and that these tariffs undermined decades of close economic cooperation. The situation highlighted the interconnectedness of the U.S. and Canadian economies and the potential for significant economic damage on both sides of the border if the trade dispute continued to escalate. The imposition of tariffs and the subsequent retaliatory measures sent ripples of uncertainty throughout the global economy. Stock markets, often seen as barometers of economic confidence, experienced volatility as investors grappled with the potential fallout of a trade war. Businesses, facing higher costs for raw materials and the threat of reduced access to key markets, became wary of making new investments. The interconnected nature of the global economy meant that the impact of these tariffs was felt far beyond the US, the EU, and Canada. The trade war highlighted the fragility of the rules-based trading system that had underpinned global economic growth for decades. It raised concerns about protectionism, the idea of countries shielding their own industries from foreign competition, potentially leading to a slowdown in global trade and economic growth. As the trade dispute dragged on, the long-term consequences remained uncertain. The world watched nervously, hoping for a resolution that would avert a full-blown trade war and restore stability to the global economy.